Listen to me very carefully, because I'm not going to say this gently and I'm not going to say it twice. The global financial system, the one you have trusted your entire working life, the one you built your retirement around, the one your bank told you was safe and your broker told you was diversified, is cracking. Not at the edges, at the foundation. And while you have been sitting there watching your stock portfolio tick up and down on your phone screen like some kind of financial spectator sport, the smartest, most ruthless, most connected pools of capital on the planet have been making a move. A quiet move. A calculated move. The kind of move that billionaires and sovereign wealth funds make before the news cycle catches up. They are buying gold, physical gold, at a pace not seen in 50 years. And if you do not understand why, if you do not act on why, the financial damage to your life is going to be real. It is going to be personal, and it is going to be permanent. Wake up. If this channel has ever put a single useful idea in your head, you owe it to yourself to hit that subscribe button right now. I do not produce entertainment. I do not make content so you can feel informed while doing nothing. Every analysis I publish on this channel is built on decades of real market experience, real capital flows, and real institutional intelligence. The kind of advice that costs serious money in any other context. You are getting it here for free. Subscribe, turn on notifications, because the next video I release may be the one you cannot afford to miss. Let me give you a number, and I want you to sit with it before you do anything else. 1,000 tons. That is how much gold the world's central banks bought in the single year of 2022. 1,000 tons. That was the highest annual central bank gold purchase total in more than 50 years. And then in 2023, they bought nearly 1,000 tons again. And into 2024 and 2025, the buying continued at levels that would have seemed almost delusional to predict just a decade earlier. Now I need you to understand something fundamental about what a central bank actually is, because most people have a completely distorted picture. A central bank is not a hedge fund making a tactical bet. It is not a retail investor chasing a trend they saw on social media. A central bank is the institution that manages the foundational monetary reserves of an entire nation. It employs teams of economists, currency strategists, geopolitical analysts, and sovereign debt specialists who do nothing but study the structural integrity of the global financial system around the clock every single day. These are not emotional actors. They are not momentum chasers. They move slowly, deliberately, and with access to economic and geopolitical intelligence that no private investor on the planet can match. So when those institutions, the ones managing the reserves of entire nations, start buying a single asset at the fastest pace in 50 years and sustain that buying across multiple consecutive years, the only rational question a serious investor can ask is this: what do they know that you do not know? What are they seeing in the architecture of the global monetary system that is making them systematically reduce their exposure to paper currencies, to dollars, to euros, to yen, and systematically increase their exposure to physical gold? I'm going to answer that question with precision and specificity. But I need you to first accept the baseline reality. When the institutions that safeguard the financial foundations of entire nations vote with their reserves, that vote is not a suggestion. It is a warning. And ignoring that warning because gold feels old-fashioned or because your financial advisor never mentioned it is exactly the kind of passive financial stupidity that separates the people who protect their wealth from the people who watch it evaporate. To understand why smart money is moving into gold right now, you need to understand the architecture they're moving away from. Since 1944, the global financial system has been built on one foundation: the United States dollar. Dollars are what nations hold in reserve. Dollars are what oil is priced in. Dollars are what global trade is settled in. The United States has benefited from this arrangement, known as dollar hegemony, in ways that no other nation on earth has ever enjoyed, because it allows America to run massive deficits and issue unlimited debt in its own currency without the immediate consequences that would cripple any other country. But that arrangement is now under more simultaneous stress than at any point in the last several decades. And the stress is not coming from one direction. It is coming from three directions at once. And that combination is what makes this moment genuinely dangerous for anyone who has not done the math. The first source of stress is the sheer scale of American debt. The United States federal debt now exceeds $36 trillion. $36 trillion. the annual interest cost on that debt, just the interest payments, not the principal, just the cost of servicing what is owed, now exceeds the entire United States defense budget. The Congressional Budget Office, which is not a political organization, projects the debt will continue growing faster than the economy indefinitely under current trajectories. There is no realistic political scenario in which that trajectory reverses without severe consequences for the long-term purchasing power of the dollar. You do not need to be a mathematician to understand what happens to the value of a currency when the entity issuing it cannot cover its own interest payments without borrowing more. The second source of stress is what I will call the weaponization of the dollar. And this is the one that changed the calculation for every serious reserve manager on the planet. In 2022, the United States and its allies froze approximately $300 billion of Russian central bank reserves held in Western financial institutions. $300 billion that a sovereign nation believed it owned, believed it controlled, believed was safely held in the most trusted financial system in the world. Gone overnight, inaccessible, politically confiscated. Now you can agree or disagree with that policy decision on geopolitical grounds. That debate is irrelevant to the financial consequence. The financial consequence is this: every central bank on the planet that is not a close American ally received an unmistakable message. Your dollar reserves are not really yours. They exist at the discretion of American foreign policy. And the rational, cold-blooded response to that message from a reserve management perspective is not to write a strongly worded letter. It is to diversify out of dollar assets and into the one reserve asset that cannot be frozen, cannot be confiscated, and cannot be blocked by any government on earth. Physical gold. The third source of stress is a slow-motion structural shift in global trade settlement. The BRICS nations, Brazil, Russia, India, China, South Africa, and a growing list of associated economies are actively pricing and systematically building financial infrastructure designed to reduce their dependence on dollar-based settlement systems. This is not an overnight revolution. It is a directional shift that compounds over time. And the direction is unmistakably toward a world in which the dollar's role as the sole global reserve currency gradually diminishes. Each of these three forces, unsustainable debt, weaponized reserves, and de-dollarization, is significant in isolation. Together, they represent a structural assault on the foundation of the current monetary order. And if you were a central bank watching all three of them simultaneously, the only asset that sits completely outside that system, completely free from counterparty risk, completely immune to political confiscation, is physical gold. That is not a theory. That is arithmetic. Beyond the central bank buying, which alone should be enough to command your attention, there is a second layer of institutional behavior that most retail investors are completely blind to, and that blindness is going to cost them. The large institutional investors, the sovereign wealth funds managing national assets across multiple generations, the family offices that protect dynastic wealth through economic cycles that most people never live to see more than one of. The macro hedge funds, operated by the most analytically rigorous minds in global finance, are quietly, systematically, and deliberately adding gold exposure. And they are doing it in a manner specifically designed to not move the price before their position is fully built. That is how genuinely sophisticated money operates. It does not ring a bell when it starts buying. It does not publish a research note announcing its thesis. It accumulates patiently, consistently, across weeks and months and sometimes years. And then when the position is complete and the thesis begins to materialize in prices, the financial media declares it a surprise and retail investors wonder how they missed it. It is never a surprise to the people who are paying attention to where capital was flowing before the price moved. There are three specific concerns driving this institutional repositioning, and I want to be exact about each one because vagueness is the enemy of action. The first concern is the trajectory of real interest rates. Real interest rates, that is nominal interest rates adjusted for actual inflation, are almost certain to fall significantly from current levels as the Federal Reserve is forced to navigate between two competing and irreconcilable pressures, inflation on one side and financial system stress on the other, and falling real interest rates are one of the most historically reliable and powerful drivers of gold price appreciation. Because when the real return on holding cash and bonds declines towards zero or goes negative, gold, which yields nothing but loses nothing to currency debasement, becomes dramatically more attractive in relative terms. The second concern is the sustainability of equity valuations in a macro environment characterized by elevated debt, decelerating economic growth, and severely constrained central bank policy. Flexibility. Many of the most respected macro investors in the world, people who have made fortunes across multiple economic cycles, have publicly and repeatedly questioned whether current stock market valuations are defensible given the structural backdrop. When you are uncertain about equities and bonds are offering real returns that could evaporate instantly if inflation reaccelerates, gold transitions from a fringe holding to a serious portfolio component, not as a speculative trade, as a genuine store of value with a 5,000-year track record. The third concern is the one that institutional investors almost never discuss in public but think about privately with considerable seriousness. What happens to a traditional financial portfolio in a genuine systemic stress event? What happens if the banking system fragility that has been building since 2022 produces a crisis that the Federal Reserve cannot resolve without reigniting the inflation it spent years and enormous political capital fighting to contain? Physical gold is one of a very small number of assets that performs precisely when the rest of the system is failing, because it sits outside the system that is failing. That is not sentiment. That is a structural property of the asset. Smart money understands that. The question is whether you will understand it in time to act or whether you will understand it afterward, when acting no longer protects you. I want to show you something that most investors are looking at directly but reading completely wrong, because misreading it is an expensive analytical mistake. There are 4 specific warning signs visible in the gold market right now that have preceded every major gold revaluation in modern financial history, and all 4 of them are flashing simultaneously. The first warning sign is the divergence between paper gold and physical gold. And this divergence matters more than almost anything else I will tell you today. The gold market has 2 distinct components. Paper gold consists of futures contracts, ETFs, and financial instruments that represent claims on gold but are not necessarily backed by physical metal in a ratio of 1-to-1. Physical gold is actual metal, bars and coins that exist in the real world and cannot be conjured by a financial institution. When sophisticated investors become genuinely alarmed about systemic financial risk, they do not buy paper gold. They sell paper gold and they buy physical gold. They demand actual delivery. And in recent months, there have been consistent, notable, and well-documented reports of unusual physical gold demand, of premiums for immediate physical delivery rising above historical norms, and of physical gold being moved from London and New York, folds the traditional centers of Western paper gold to more secure locations outside the Western financial system. When the smart money stops trusting the paper and demands the metal, that is not a subtle signal. That is a flashing red light. The second warning sign is the behavior of gold mining stocks. Mining equities typically move ahead of the metal itself in a genuine bull market because sophisticated investors price in the future profitability of mining operations at higher gold prices before those prices are fully achieved in the spot market. A sustained pattern of gold mining stocks outperforming the physical metal is one of the most reliable forward-looking signals that the investment community is making a strong and confident bet on materially higher gold prices over a meaningful time horizon. That pattern has been developing. The third warning sign is the geographic movement of physical gold itself. Gold is quietly but consistently moving from west to east, from London and New York to Shanghai, Mumbai, Dubai, and other centers of Eastern economic power. This is not a random market phenomenon. It directly reflects the geopolitical and monetary realignment I described earlier. The countries and institutions most actively reducing their dollar dependence are also the ones most aggressively accumulating physical gold. The metal is literally moving to where the new centers of global economic gravity are forming. If you understand the geopolitics, the movement of the gold makes perfect sense. If you do not understand the geopolitics, the movement of the gold should make you study them immediately. The fourth warning sign is what central banks are not saying publicly, which in many ways is more important than what they are Central banks are legally required to report their gold holdings, but the timing, frequency, and precision of those disclosures vary dramatically across institutions. Multiple credible analysts who specialize in tracking these flows have produced substantial evidence that actual central bank gold accumulation is running significantly ahead of officially reported numbers. The record buying I described earlier, the 1,000-ton years, may itself be understating the true magnitude of the shift currently underway. When official data is already historic in scale, and credible analysis suggests the official data is an undercount, the actual signal is more powerful than even the headline. Numbers suggest. I have spent this entire video explaining the why. Now I am going to give you the what, specifically, mathematically, and without the vagueness that passes for financial advice in most places. 5 steps. Execute all 5 or do not complain about the outcome. Step 1. Understand the fundamental difference between paper gold and physical gold and own the right kind. A gold ETF gives you price exposure to gold in the same way that a receipt for a car gives you exposure to transportation. It is a claim. It is not the thing. In a genuine financial crisis, the specific scenario that the institutional buying high, described as hedging against a gold ETF, is subject to the same risks as every other instrument in the financial system. It can be suspended. It can be subject to emergency regulatory action. It can fail to deliver. Physical gold that you hold in your direct possession cannot be suspended by an exchange, cannot be frozen by a bank, and cannot disappear because a financial institution with a claim on it decides to fail. If you are buying gold because of genuine systemic risk concerns, and given everything I have laid out today, you absolutely should be. The physical metal is the only form of ownership that provides the protection you are actually seeking. Step 2, size the position correctly, and I mean mathematically correctly, not emotionally. I am not telling you to liquidate your stock portfolio and convert it to gold bars. That would be as analytically unsound as putting everything into any single asset. What the data on institutional allocation consistently demonstrates across sovereign wealth funds, endowments, and the portfolios of the most respected macro investors in the world is a range of 10 to 20% of a serious investment portfolio allocated to physical precious metals in a high-risk macro environment. Not 5%, which is a hedge against embarrassment, not 50%, which is panic wearing a strategy costume. 10 to 20%, that range provides meaningful systemic protection and meaningful upside participation. If the structural forces I described continue to develop, as the institutional buying pattern suggests they will, run the number on your own net worth, calculate what 10 to 20% actually represents in dollar terms. Then treat that number as a target, not an aspiration. Step 3, think with absolute seriousness about where your gold is stored, because ownership without access is not ownership. Physical gold held in your direct possession in a high quality home safe that is bolted to a structure or in a private non-bank vault is the most secure form of ownership available. If your gold is stored in a bank safe deposit box, I need you to understand exactly what that means in a crisis scenario. If your bank restricts depositor access, which is a documented historical event, not a conspiracy theory, you cannot reach your safe deposit box either. The bank controls access, period. For any meaningful allocation to physical gold storage outside the banking system is not a preference, it is a requirement. Step 4, approach your purchases with discipline by dollar cost averaging across a 3 to 6 month window rather than making a single large purchase at a single price. Gold, like every asset, moves in cycles within its broader trend. There will be weeks when the price pulls back and your purchase looks smart, and weeks when it moves against you and your purchase feels premature. Neither of those short-term fluctuations matters. The structural forces driving this gold bull market are measured in years, not in weekly price swings. Spreading your purchases across time removes the psychological burden of trying to time a market perfectly and allows you to build a meaningful position at an average cost across a range of prices. The thesis is structural. The execution should be methodical. Step 5, and this is the one most people resist because it requires a fundamental shift in how they think about this asset. Stop thinking about gold as a speculation and start thinking about it as insurance. The entire mental framework changes when you make that shift. You do not buy fire insurance because you are certain your house will burn down. You buy it because if it does burn down and you do not have it, The consequences are catastrophic and permanent. The cost of owning gold, if the systemic risks I have described do not materialize, is modest. Some opportunity cost relative to stocks in a raging bull market. Some foregone interest relative to bonds. The cost of not owning gold. If those systemic risks do materialize in a way that institutional money is clearly, systematically, and expensively positioning for as potentially severe and potentially irreversible, that asymmetry, modest cost of preparation versus catastrophic cost of being unprepared, is the entire mathematical case for owning physical gold right now in this specific macro environment. At this specific moment in monetary history, I'm going to leave you with one final thought, and I want it to land with the weight it deserves. Every major gold bull market in history has had exactly the same characteristic in its early and middle stages. The institutional buyers accumulate quietly while retail investors stand on the sidelines debating whether the move is real. Then the fundamentals become undeniable. The price accelerates. The financial media discovers it. And the retail investors who were waiting for a more comfortable entry point realize that the comfortable entry they were waiting for was the price they refused to pay 6 months earlier. The people who recognize the structural gold bull market in 2001, when gold was near $300 an ounce and held through a decade of gains, captured a move to over $1,800 by 2011. Most retail investors missed the majority of that move because they were waiting for a pullback that felt safer. The structural similarity between that period and this one is not superficial. It is striking, specific, and well documented. I am not telling you that gold goes straight up from here. I am telling you that the structural forces behind this move are the most powerful and most broadly supported they have been in a generation. The smart money is already positioned. The central banks are already positioned. The sovereign wealth funds are already positioned. The macro funds are already positioned. The window to join them before this becomes front page news and the price fully reflects the institutional buying already underway is open right now, not for much longer. Right now, stop being passive. Stop waiting for permission. Stop pretending that doing nothing is a neutral decision. Because in a market moving this fast and with this much institutional weight behind it, doing nothing is a decision with consequences. Make the choice. Make it with clear eyes, honest analysis, and full awareness of what is at stake. The question is not whether smart money is buying gold. I've given you the data. The question is whether you are going to be in that position when the rest of the world figures it out, or whether you are going to be the person explaining to yourself in 2 years why you knew and still did nothing.